In December 2024, the federal government finalized a rule. It was projected to save American families close to $5 billion a year. It was scheduled to take effect on October 1st, 2025. It never got there. 5 months after it was finalized, 5 months before it would have applied to a single transaction, Congress voted to kill it. The president signed that repeal into law. The rule would have capped most overdraft fees at $5. Banks had been charging up to $35. In 2025 alone, that fee cost Americans over $12 billion. And here's the part almost nobody knows. Roughly 3 out of every 4 households never pay it at all in a given year. This isn't a story about a fee everyone pays. It's a story about a fee engineered to be paid over and over by the same small group of people. And a rule that could have stopped it, killed 5 months before it had the chance. The fee is called an overdraft fee. It sounds simple: spend more than you have, get charged. But the mechanism behind it is anything but simple. For years, some of the largest banks in the country engineered it to multiply. It didn't start this way. Back when checks were the primary way people paid for things, banks would sometimes cover a shortfall as a discretionary courtesy. A favor extended to a trusted customer with no formal fee structure attached. Somewhere along the way, that courtesy got systematized into a fixed charge, applied automatically every time, whether or not it cost the bank anything close to that amount to cover. Here's how the modern version worked and why it mattered so much which order things happened in. Say you have $100 in your account. You buy coffee for $11, then groceries for $75. Then you make a payment for $100. You're now overdrawn, but only on that last purchase. One fee. Except that's not what some banks did. Internally, they had the discretion to choose the order transactions get processed in each day. So instead of processing your purchases in the order you actually made them, they reordered them. Largest dollar amount first, smallest last. Suddenly, that $100 payment posts first. Now your coffee overdraws you. Your groceries overdraw you. What should have been one $35 fee becomes $3 on purchases you'd already made. In an order the bank rewrote after the fact. This wasn't a glitch. In a landmark 2010 case, a federal judge reviewed an internal Wells Fargo memo. It predicted this exact reordering would generate an extra $40 million a year. An outside analysis of a real customer's account in that case showed the effect directly. An $11 purchase reordered behind an $80 one. It turned a single $22 overdraft fee into 4 separate fees totaling $88, quadrupled from one afternoon of ordinary spending. The numbers back up who this actually hits, year after year. CFPB research shows roughly 9% of bank accounts overdraft 10 or more times a year. That 9% accounts for about 79% of all overdraft fee revenue in the entire industry. Meanwhile, 3 out of 4 households never pay this fee at all in a given year. Some banks, Capital One, Citibank, American Express, Ally, charge none of it. Proving the fee was never structurally necessary to run a checking account. It's not a cost of doing business, it's a business model. Built on a small, predictable, repeat-paying customer base. The reordering scheme didn't survive without consequence. Starting in 2008, more than 30 banks were hit with class action lawsuits over the practice. they eventually settled for a combined total exceeding $1 billion. Wells Fargo alone was ordered to pay $203 million in restitution. A judge found the bank had, in his own words, engaged in gouging and profiteering. The bank stopped reordering debit card purchases in 2010, but kept doing it for checks and automatic payments until 2014. 4 more years on a technicality after being caught. Then, in December 2024, the Consumer Financial Protection Bureau finalized a rule. It would have ended the ambiguity entirely for the country's largest banks, institutions holding more than $10 billion in assets. Cap most overdraft fees at $5, or require the bank to only charge what it actually costs them to cover the shortfall. The CFPB projected this would save the households that actually pay this fee roughly $225 a year, $5 billion nationally. It was scheduled to take effect October 1st, 2025. Banking trade groups sued to block it almost immediately. But they didn't need the courts. Using a fast-track legal tool called the Congressional Review Act, the House Financial Services Committee advanced a resolution to kill the rule outright. The Senate passed it. The House passed it. On May the 9th, 2025, 5 months before the rule would have ever applied to a single transaction, the President signed the repeal into law. The American Bankers Association, which had sued the CFPB over the rule, dropped its lawsuit that same day. It no longer needed one. By the end of 2025, banks and credit unions had collected over $12 billion in overdraft and related fees, back to nearly the same level as before the crackdown ever began. JP Morgan Chase and Wells Fargo each individually pulled in roughly $1 billion for the year. One bank had cut its fee from $36 to $15 in anticipation of regulation. Its own overdraft revenue collapsed from $27 million to $2 million. It reversed course in 2026 once the rule was gone, raising the fee back up to $20 and shrinking the balance cushion that protects customers from a fee at all. Go back to the mechanism itself, because the math is worth sitting with. In the case behind the landmark ruling, one customer's account is documented in the court record. An $11.27 purchase at Subway reordered behind an $80 charge that came later in the day. Her account drained to empty within 8 transactions. What should have been 1 overdraft fee in the order she'd actually spent her money became 4, quadrupling from $22 to $88 per an outside analysis of the case. This wasn't a person who was reckless with money. This was someone whose bank quietly rearranged the sequence of her own purchases after the fact, specifically so more of them would fail. She didn't spend differently. The bank changed the order in which it counted what she'd already spent. This pattern hasn't stayed in the past either. Active investigations into banks and credit unions charging overdraft fees on accounts that were never actually overdrawn are still opening this year. The system doesn't need to target anyone by name. It just needs enough people living close enough to zero, often enough, for the math to work at scale. 8% of customers in a 2014 federal study, 9% in the CFPB's most recent research, generating close to 80% of the revenue year after year. The 3 out of 4 households who never see this fee have no reason to ever notice it's still happening to someone else. What makes this fee different from most hidden costs is that it isn't hidden in the fine print. It's hidden in the order of operations. Nobody needs to read a disclosure to understand you'll be charged if you overdraw your account. What almost nobody understands is that the bank has discretion over what counts as overdrawing it in the first place. Transaction by transaction, in whatever order, maximizes the fee count. It works because the harm shows up as several small, separately justified charges instead of one obviously outrageous one. $35, 3 times, on 3 completely different purchases feels like 3 separate mistakes you made. It's actually one mechanism applied on purpose to one moment, engineered so that the person paying it experiences it as their own error, not as a decision the bank made about them. The rule that could have ended the $5 version of this story is a new one on the dead, reversed 5 months before it ever applied to a single transaction. The banking trade groups that fought hardest against it are, unsurprisingly, the ones now reporting the highest overdraft revenue. A handful of banks have shown the fee was never mandatory to begin with. They simply chose not to charge it and kept operating checking accounts just fine. For everyone else, the same shrinking, predictable slice of customers will likely fund a meaningful share of the industry's fee revenue again this year, and the year after that, until the next rule gets written. And, if the last one is any indication, fought and possibly undone again. The next time a rule like this comes up for a vote, it won't be argued about in terms of transaction order or posting sequence. It'll be argued about in terms of consumer choice and access to credit. Worth remembering what the actual mechanism looked like the last time anyone bothered to open it up and look.